Record. Okay, cool. So basically, how we view the market, we have our impulse, correction, and continuation. Now, our impulse tells us which direction the market wants to go. This correction right here, this pullback right here, confirms that the market does want to go in that direction. So, for example, if you want to transfer some money in your bank account, right? You're gonna say, "Oh, I want to make a transfer," telling basically your phone or the teller what you want to do, right? They're gonna ask for confirmation that you do want to go in that direction. They're gonna ask for confirmation that you do want to make that transfer, right? Before it actually happens, before the transfer happens, they're gonna ask for confirmation. They're gonna ask you to confirm it. And then after that confirmation, then the continuation happens. Then that money gets transferred into your other bank account or other account. That money gets withdrawn or whatever, right? Same thing going down. Impulse tells you the market wants to go down. Correction confirms that it wants to go down. It's gonna say, "Are you sure you want to go down?" It's gonna give you a pullback, be like, "Yeah, I want to go down." All right. Then continuations is the actual execution of that process actually happening. Okay. And this is very, very simplified about what I'm going to show you in a second. But essentially, before I do that, after the correction is always going to form a pattern. So you guys hear like people talking about flags, expanding triangles, wedges, stuff like that. This correction is going to form one of those patterns, and when you see that pattern, you basically want to figure out when that pattern is going to end, and then look for the up move, right? So a real simple way that show people how to figure out when the correction is over and when they should enter is basically trends, right? So basically, what a good trend is, it's going to be a series of impulses and corrections. Okay. Okay, perfect. So an uptrend is just going to have a series of impulses and corrections, just like this. Perfect. Impulse up, correction, impulse up, correct it down, impulse up, correct to the trend line, you could have bought the trend line. And then it broke this trend line impulsively, right? And it created a new downtrend, just like this. Got an impulse down, correction here, impulse down, another correction, impulse down, correction. All right. Anybody have any questions over that at all? Okay, perfect. So now I'm going to show you what it looks like in the market. And if you have trouble seeing it on your own, definitely go to your own chart and practice it. Practice finding it. Okay. All right. And like I said, I'm going to keep it really simple. I'm only going to stick with impulses and corrections. I'm not going to talk about channels today or anything like that. And then afterwards, I'll have Skylar take it over, give you guys a little bit of the institutional side of things. Okay, perfect. So what type of trend we got right here?
Downtrend.
A downtrend.
Perfect. We got a downtrend. And then at this top of this downtrend, we have a impulse here.
I impulse a correction, then I impulse a correction.
All right, perfect. Impulse, correction. Then we got another impulse, right? We got an impulse, correction, discontinuation. Now, discontinuation is the same thing as our impulse, right? Impulse and continuation are the same exact thing, right? They're the same exact thing. So really the market moves like impulse, correction, impulse, correction. Okay, perfect. So after that correction, corrected to our trend line, then we got a continuation down, all right? And that continuation is our new impulse. Every time we get an impulse, we're going to wait for a correction, because the only way that move is going to continue in the same way that it impulsed is if we get a correction. Okay, so after every impulse, you want to wait for a correction to form so that you can get in on the next impulse that is going to happen. Does that make sense?
Yes.
All right, perfect. So, those are just some examples of downtrend. Let's find an example of uptrend. Here we go. And I'm only choosing the ones that are really clear. If you do have any trouble, just let me know, and like we can talk and figure it out together. All right. So over here we have a clear impulse. All right. Then we have a correction here. Am I telling the truth? Am I lying? Am I crazy? Mike, they say I'm crazy, bro. They don't see it.
No, I see it.
Okay, cool. I thought I was the only one.
No.
So, so we got an impulse up here, we got a correction here, and then we form our trend line, right? So let's actually see in action, because like y'all know the market don't actually look like this. We don't actually know what's gonna happen. So let me delete the trend line, and we're gonna do it exactly how it's gonna be. So earlier we had this downtrend, right? If you wanted to call this a downtrend, I'm actually gonna take it from a lower point. Let's say you don't know that this is a reversal pattern, and let's say you saw this downtrend. It broke through your downtrend, created an impulse, then created a correction, and then gave you that continuation. Now you have a clear impulse, and you're just waiting for a correction. Okay, so what you're gonna do first of all is draw your uptrend like that. You got 2 points. Now you're gonna wait for this correction to form. Let's play a few candles, see if it forms. Perfect. We see this is correcting down. Okay, and the way that I know that it's correcting, I'm not having strong long candles going in one direction. I have red candles, green candles going back and forth, and they're overall either heading in the down direction, right? They're not going straight up. They're going generally down. So we're gonna play a few more. Jesus. All right. That thing went crazy. All right. And now we can draw out this pattern. We see we have a correction. Am I losing anybody, or everybody seeing what I'm talking about?
Spot on.
All right, we solid?
Yeah. Oh, yeah.
Okay, bet. So now I'm gonna continue playing. Now that you know that this is happening, all we got to do is find an entry for our buy. Okay, we got an impulse up, we got a correction coming down. That means we're going up.
This is literally my class. But I'll be at work, so I can't have my class.
Hold on. Who's that?
Oh,
Yeah. All right. Thank you, bro. All right. Cool. Okay. Yeah. So we got this correction here. My bad, guys. Got this correction here, and we're looking for an entry to buy, right? So the ideal place to buy is going to be on top of the previous correction. Okay. If you guys been on my call before, y'all know I call this a kill zone. I'm gonna just use a horizontal. Matter of fact, no, I won't. Let me not be lazy. Put 110% in. All right, so here we go. We're at the top of the previous correction. Previous correction, top of it's right here. We're looking for price to enter this zone, come right near our trend line, and all that stuff. And we'll enter in that area. All right, now we're in that area. Now we would go to a lower time frame and we look for. Let's do it. We go to a lower time frame and wait for an engulfing candle, right, for that safety entry. Let's find it. Okay, this is a pattern. It's 3 white soldiers. If you're not comfortable with that, we can wait for another engulfing candle. Ah, sheesh. There's your engulfing candle. That's wild. All right, I'm not going to enter out for that. But if you bold enough, you can. Bug that. But ideally, you want to enter right here, right? Normally, it's going to give you an engulfing candle. Ideal place to enter off of is 15-minute, 1 hour. I like to enter off the 1 hour personally, because those candles are way stronger than the 15-minute candles. And when you go to lower time frames, it's quite easy to get faked out if you have tunnel vision focusing on candle by candle, if that makes sense. If anybody ever experienced that, I hope I'm not the only one. Matter of fact, I hope I am. But yeah, let's go to a lower time frame. We see we have a W here. Let's see if we see this engulfing candle that we missed on our time frame. What do you say? All right. So since we have our W, we have 3 white soldiers right here. This is the candle that I would enter off of. And then knowing that this is Euro USD, I know 30 pip stop loss is gonna be sufficient. Or even if you're not comfortable with that, you can set like a, I don't know what y'all comfortable with. But yeah, so I'm gonna just put it right below the zone for 20 pips and then go up to the top of this correction because that's my first take profit, which leaves me with about 20 to 30 pip profit, right? I'm risking 15, 17 pips for a 30 pip take profit. Okay, if anyone got lost throughout this process, let me know before I just continue on because this is essentially it. All right. Does this not make sense to anybody or does it make sense to everybody?
No, it makes sense to me.
Okay, perfect. I'm happy it makes sense. So I'll go ahead and drop this recording in the chat afterwards. But I'm actually going to pass the call over to Skylar. He's going to drop a lot of knowledge on you guys, institutional wise, to basically help you guys understand what the banks are thinking and how they're like tricking you to take your money or tricking the regular retail trader in order to take their money, right? So he's very, very knowledgeable, bro. He has so much information. I know he's gonna provide you a whole lot of value. And I'm not just saying that. Like for real, take notes. Cause like me, I'm definitely gonna be taking notes because I know Skylar, like he's just on a whole nother level. I promise you guys. So Skylar, you on? I'm gonna go ahead and pass it over to you.
Thank you, Dakota. I appreciate that, bro.
Yeah, no problem, bro. Take it over.
All right, let's rock. All right, let me get to a working screen here. All right, was you guys Christmas?
Man, it was short,
Yeah,
as always.
all days. All right, then we're ready to get started here. All right, can you guys see my screen?
Yes, sir.
All right, awesome. All right, let's get started. All right, so with institutional trading, guys, like Dakota was telling you guys, it's basically really understanding what the banks are doing and how they're moving price and how they're out to actually manipulate retail traders to basically gain liquidity and make their moves in the market. And the thing about institutional trading, guys, is actually really, really simple. And so I'm going to take a look at a few examples here on the charts of some moves that actually have taken place here recently on the GBP pairs. I know a lot of people make money off GBP pairs. So frame, and I'm going to just break it down into the intraday concepts. Okay, I'm not going to try to overload you guys with too much information, but I want to give you guys 2 stories. I want to give you guys a buy model, and I want to give you guys a sell model. On this one, I'm going to talk a little bit about like key levels off the higher time frames and how liquidity is moving around in the market. Okay, so that's why I'm pretty much start from the higher time frame premise, and you can understand here. So here on GBP USD, you can see on the monthly chart. When you look at these equal highs back here, you come 50% into this candle. So you guys see this candle right here. So if you take your fib from this institutional level here and pull it across the body of the candle, you can see we came right into that 50% area of that monthly candle. And I'm going to explain to you what that means. All right, so I'm going to take off those fibs. All right, cool. So they really just like skinned it like right there. Now, when you look on the higher time frames, like what's really important, guys, when you're looking at monthly, weekly, and daily, you really want to look at like what the smart players are doing and like where liquidity is in the market. So what I'm seeing right here on the monthly time frame, you can see this particular swing here. This particular swing right here is really important because it's significant because you have a series of buyers and you also have a series of sellers. Can you guys see that? So this was a strong key area off the higher time frame because this is a monthly swing. Okay, So that's what we essentially are looking to understand when we're looking at institutional levels is monthly swings. The same way we had these lows down here, these monthly lows, when price came back down into these levels right down in here. You can see where we was offered liquidity right below these lows down here. Okay, so back to the lower time frames down to the daily. So what you guys can see here, before we started this big up move, you can see that we had this extended run down that literally started from May, early March of 19. And the thing about institutional trading, guys, it's really about understanding time, when time and price relationships meet, okay? And that's what's really gonna bring precision to your trading, because when you can begin to map out these higher time frame premises and these higher time frame objectives, then you begin to be able to time the market and to be able to sync the market with what the big players are doing. And then you're able to find yourself getting in line with that movement, and you're able to catch those 300, 400, 500 pip moves that we see occurring right now. So what you can see here in this particular pattern, right? This is a very, very interesting pattern, because you see this downtrend, right? But a lot of times what the retail trader is thinking to themselves, okay, how am I going to get in? Of course, yes, we do see a break of structure and we see a return. And so this is what I actually want to explain right here is the actual return for price. So on the daily, when you see this higher time frame make the impulse and we transition and we have this second wave, you can see right here that price returns right back into this liquidity area right here. When price turns right back into this liquidity area right below these lows, you can see that's when price actually took off. Okay, so this same premise is gonna apply itself through all time frames, on the daily, on the 4 hour, on the 1 hour, on the 15, even down to the 5 minute chart, all the way down to the 1 minute chart. Okay, so I'm gonna break it all the way down. So I'm just trying to get you guys to understand the higher time frame premise. So when we look at price impulse and we look at price return, what we're looking at is something called liquidity. When you have these impulsive candles here, typically price likes to come back in and revisit these liquid areas, because these areas right here is what allow institutional sponsorship to drive price up. And you'll see price from outside structure. And when I say outside structure, this is the outside structure of an impulse, and the corrective side is the inside structure. So when price is returning back into the inside structure, returning back, you're looking for price to sweep these equal lows. So when you look at these lows right here, you can see how they swept these lows, went just below it, returned right back into this liquidity area, and you can see how price took off. Okay, is that making sense to you guys so far? Just in the basic concept, am I talking too fast? Am I talking too fast?
So far, so good, bro.
Okay, because I assume most of you guys on this call is intermediate to advanced traders, so you guys have a pretty good understanding of the market and impulse and corrective cycles in the market, right? So you guys can grab these concepts really, really easily, really, really easily. Okay, so now let's move to current price. Let's move to current price, and let's talk about how we got this nice move here down after we had that big spike up. We had 476 pip move. I actually caught this move. I caught this on 3 different pairs. It was over like 1,400 pips on this particular setup. So let's get into the intraday of it. So after we had this big spike up, right, and you saw price make the retrace, what I want to do is actually show you guys how we break this down into time. So the thing about the market is you want to understand that when the market opens and when the market actually closes. And you want to understand the open of the day, the A range, and you want to understand the close of the day, okay? So I'm going to drop down to the 15-minute. So you can see when we had that big spike up on the GBP pairs, you see right here, I'm going to draw from 20. I'm going to draw from 20. All right, and I'm going to draw to 0. Draw right here to 0. All right, so essentially right here in this box, what I'm delineating is literally from 8 p.m. to 12 midnight. What do you see in this area here? We have a fake to the high. We have midnight here. 2 o'clock, they set the high. And we're letting you know, because we're smart money traders, we're looking to sell above the previous highs, coming back into the what? Previous day what? High. See that? That's the previous day high. Why? How do you know this is the previous day high? If this was the open and this was the high of A range and they set a new high, this would be the previous. This would be the previous high. This would be the previous low. This would be the next current high, and they came back into what? Previous what? High. Clean setup. And that's the beautiful thing about GBP pairs, guys, and why I love them so much is because they're engineered really, really well. Liquidity is engineered very, very well. I'm gonna actually make this easy for you guys. I'm gonna turn on my Patty trading sessions, and I'm gonna walk you guys down through an intraday navigation concept. So what I've already delineated from my Patty trading range is from this tool here is from 8 p.m. to midnight. So with this particular setup right here, you can see they literally just came right back into, they had the low, and they had that high. So what do you already understand here? We already had an impulse. We already had an impulse here, right, guys? So now we have an impulse already. And so now when we start looking at the corrective cycle, we're literally going from 1830 and we're watching all the way to what? Midnight, right? We got an early manipulation right at midnight. Boom, our price goes. They didn't manipulate. But what did they do the day before? They did a manipulation move. They did the stop hunt move. See the difference? So from this area here, you can see they came right back up into this liquidity area right up in here. And they came and filled right in that gap, manipulated right above the A range high. Manipulation candle. We selling right above the A range high. Boom, clean move. And then if you wanted to swing this move, when we came back into day 2, we had that final impulse at the end of New York. Let me see. In New York is right here. So right into A range, we had that final impulse. We had that corrective cycle, opened up, and then we got the second entry on the swing trade. Now right here, pretty simple as well. Even on narrow ranges, what do you see here? You see you had these highs. You see you had these lows. You see they came right back up into that bearish engulfing candle. They came right back up into that zone, set a high, and you would have sold right above these highs here, and you still would have been in profit. Now right here, you can see a nice, beautiful setup right here. This is a nice example right here. You see we have 8 to 12. It's the same thing every single day. So this is sale model, guys. This is literally a sale model here. So you have the lows, you have the highs, and see what the A range gives you guys is the no trade zone. So it gives you the no trade zone. This is the dealer's range where they're accumulating price. They're accumulating orders right in this area here. And so the difference in the psychology of the institutional mindset is that you understand that you have specific behaviors that you recognize. You have in this particular situation, what I'm delineating is what we like to call a sale model here. This is a sale model. Why? In a sale model, what do? They fake to the high, drop low. And so literally what institutional mindset is understanding is where the liquidity is. So look how they come right back up here into these highs. They come right back up into these highs for liquidity, right? And they actually come back into 50% of this range here. So if I take everything off and I take my fibs and come right here into the 50% of this range, What do you see when they come from that 50% of this range? Stop hunt. Right there. See that? So right above this area here, after you would have had the impulse, what do you see? Price came right up to that 786. You could have had a limit order here. You would have been wicked into your entry, and then price would have left off. So that's a couple more tricks that you can use with this technique when they stop hunt like this, that 786 and 886 off that previous drop, and they want to come back and stop hunt. You could take this from the high, the A to B, and they typically engineer liquidity right up in here, 886, 786. $13 pips. You would have been wicked in. For a potential 119 pip move. All right, so look. All right, so now, of course, so we see the sell model, right? All right, let's start talking about the buy model and what happened this week, okay? So I'm gonna break this down from a 4-hour time frame. Break this down from a 4-hour time frame for you guys. So what you see, what I'm using here is all of these stripes really just represent time. So I'm navigating market structure through time and price relationships, and I'm navigating the market from the open of the week, which is on Sunday at 5 p.m., and I'm navigating it to Monday's open and close. So what I'm able to do is see the high and low of a week in a buy model or a sell model. In a sell model, we've seen the high and low in this Monday's range set early off from Sunday, and then we move right through Monday through London. What do you see in this particular situation right here when we opened up this Monday here? This is how we knew we were preparing for the buys, is because we started the week off what? We started the week off at a low on the Monday. So what I understood from Sunday is that typically on what they do on Friday, they continue on Sunday, right? When the market opens. That's the reality I begin to come to, is that when you look at this point in time, and I'm going to delineate to you guys a specific time, because this is really what's going to give you guys the roadmap to really navigate in the markets, because understanding the impulsive side and the corrective side is the foundation to your trading. Market geometry, that's the foundation to your trading. Identifying patterns, that's the intermediate and advanced part of your trading. Institutional concepts, it's the next level above that. That's what's going to bring the precision and the navigation to when it actually happens. It's knowing something is going to happen and then understanding how to get in at the right exact time when it happens. And that's what these concepts teach you. They're very conceptual in the fact that they need to be understood and implemented into your trading. And it has to become something that you understand and internalize, because it really brings a great internalization to price behavior and manipulation. Because when you understand how the market is manipulated, it's like the idea of the casino. Like any of you guys, ever been to the casino? It's an odds game. It's odds, and that is a zero sum, where that you have to know how many chips is left on the table, right? You have to know what chips is left on the table in the context of the overall delivery of price. When price was dropping, you understood that the overall delivery price was being delivered in a downtrend, right? So with the context of market structure, you have that understanding of price delivery. So and this is where I get into a little mindset, but when traders are talking about they're trying to get their ego under wraps, and people are studying trading psychology books, I think trader psychology is one part of it, but it's also understanding that as a human being, you're taught to be right. As a human being, you're taught to be a leader. As a human being, you're taught to stand out front. You're taught to be right. You're taught to make good grades in school. In the market, it's completely opposite. Your job is to become a great detective. Your job is to become a great follower of the market. You have to learn how to follow. So when you're internalizing institutional concepts, is that you're tracking the dealer and understanding where he needs to go and grab money, and where does he need to find money to continue his objective. Where does he need to reach and grab liquidity to finish his objective in his overall, in the big picture objective, the daily objective, the 4-hour objective. You make sense? So anytime you come down below the 1 hour objective, that's intraday objective. But high probability intraday scalping, as we call it, is when you can align it with the daily and 4-hour time signatures. This is how you're able to do it. You have to map it out in time. It's because you have to map it out in days of the week, and you have to map it out in time. And so when you map it out in time, then you can begin to actually hone in on the range that you're actually dealing in. Does that make sense? Now you can take your mind off the bigger picture, and now you can zoom in, and now you can begin to navigate your Sunday, your Monday, and your Tuesday. Make sense? Your Monday, Tuesday, Wednesday, Thursday, Friday, so on and so forth. We had a short week this week. Why? Because of the holidays. So that doesn't make sense. We got a Monday, and then all of this, and then this, today. So market was closed. But however, you get the premise, is that these time signatures, that's what brings the precision, because now the same market structure that's on a higher time frame, it's the same skill set on the lower time frame. And so you have to have what's called an intraday support and resistance. And so what provides you that? What provides you that support and resistance information? This information right here. So what this green line represents, delineates, is Monday. This is Monday's what? High. This is Monday's low. This was the A range, and this was the equilibrium. This was the equilibrium of price, right? So as you guys can see, when we opened up on Monday, simple and plain, what did we do? We had 8 o'clock to midnight. Same thing. 8 o'clock to midnight. And we also knew that from the close of the week, we had a what? We had a big what? Liquidity gap, outside structure. Make sense? And so what we know is that when the market opens up at the top of the week, when they completed this last initiation here and they set these lows, the market was opening up here. So we knew the market had to return to more liquid areas. The market had to return to more liquid areas. Why? Because we opened up the week, what? Setting lows. We opened up the week at a what? Low. We didn't open up the market at a what? High. We opened the market at a high. So that basically helps you begin to understand the dealer's cycle. We had how many days of drop? 1, 2, 3, 4. 4 days, 5 days of drop, right? And then we opened this week at a what? Low. So what do you know about Sunday and Monday? They set the what? High and low of the what? Week. It's called the weekly range. So now that they've set the low, now you have a what? A range to work in. So what do you have in context of everything before that? You automatically have market structure. You know that the market was in this down move here. You know that. You know that you had this trend line, right? You know you had this breaker structure. And so now when you come into this area, now you got a map. Make sense? Now look at the map. So now when I look at this, December 23rd, December 23rd, it's December 23rd, December 24th. Yeah, December 24th. So when we go back and look at those days on the calendar, the 23rd was Monday, so the 22nd was Sunday. So 22, right here. What is this? What does that particular area represent right there? Sunday, 1700. 1700. Huh? This was this Sunday. This was just Sunday, right here. Yep, the 22nd. Let me pull this information up. Am I correct? You see the 22nd is Sunday. So the market opened on Sunday. So this is what I'm connected dots. So if this is Sunday's correction from right here, what is this information over here? What information is that?
Is that the high of the previous?
That's Friday.
Yeah.
That's Friday's information. So what did I say about what the market likes to do on Sunday from what they do on Friday? They like to continue what? They like to continue their objective from what they did last week. They typically, for some reason, when they close like this on Friday, they will open up the market like this. And then what do you see by 3 o'clock? Watch this. I'm going to give it to you. Clear as cut day. Right here. So when the market opens, we already got a game plan. Impulse what? Correction, right? All we have to do is delineate what? 20, right? Delineate 20, right? We delineate the 20 candle, and we come right up to 00. And we isolate that area. What do we get right? What do we get right here above London Open? We give you what? The first push up, 130, right? You get a push up, and then 3 o'clock, London Open, bam. What do you get? You get the move. And so like Dakota was telling you earlier, what do you have right here? It's called the London Kill Zone. Boom, right? So now you have the open of the day right here, 12, right? It's all about time, guys. It's all about time. Look at that, midnight. See, 8 to 12. I can't make this up. You see, they make the one push up by 130, right around here, 130. They make the first push up. They push down 215. They push down 215. They set the next high. Come right back into a what? Come back into a bearish candle, a return candle. So now when you look at these specific wicks, most people don't look at this. Let me clean this up. Look how it comes right back into these return wicks right here. Punch wicks, bearish candle, order block. So then when I'm looking left, this is what looking left really means. This is what looking left really means. You see, now we inside of this order block. Simple and plain, the context of it was 20. Boom. Boom. Makes sense, right? And 0. See? And that's how you make the play. And so that's the sale model. All right. So 114 pips. All right. So like I was telling you here, so let's move on to the buy model real quick. I don't keep you guys all night. You guys getting some value from this? You guys get some value?
Man, we are.
Yeah, I know. Yeah.
All right, cool. That's what's up. That's what's up. That's what it's all about. All right, dope. So let's go. All right, so look, so we got here. Like I was delineating from you guys, you know, we had that, you know, breaking structure, right? We had the breaking structure. So in this time right here, what was this time right here? Can nobody do crap right here, bro? Can nobody do nothing right here? Why? Let's look at the clock. 25th, 24th, 25th. Can nobody do nothing? Market open up 26, 27, right? So let's look at 25th, 24th, and 25th. So 24th, look how we skipped the whole 25th. 24th to the 25th. So 24th was Tuesday. So they make that first rise. Right, 26, that's Thursday. 26, 7. So if you didn't trade on Thursday, this was today. So let's get to the day. So now, let me see what this is. 20 to midnight. Okay, so they did something a little different here this time. Let me see, 20. Different theme. Same concept, but different theme. Look at this. Look how they moved early last night. They moved real early last night. They didn't even cross midnight, Doc. Look how early they were. They didn't even cross midnight. They came out the box early. Look at that. But you still had the information. Why? Now let me get a little cool with you guys right quick. So when we had level one, this was called level one rise. Why? They set the low of the week and they begin to move away, right? So if they set the low of the week here, Monday, they open up. What do? They open up, consolidated, accumulated. Look how they swept right below these lows. They swept right below those lows. See that? So they came out of the box, swept right below those lows. They did a false breakout move, through a false breakout, and what we waited on was the second leg. So we waited on that second leg formation. We moved away. So from that move right there, 60 pip move. If you would have swung it, of course, what I would have did is you could have swung it and then you could have rolled it up here, right? TP2, right? And then, you know what I'm saying, you could have closed the trade. Because the thing about intraday navigation is if you don't want to be a full-on swing trader and hold the swing, then you can navigate the swings through this concept. Or you can have, it's trader's choice with money management. Like you can book 50% of your profits and then let the rest run. You know what I'm saying? Day number 2, stack your orders and then keep riding price up. So trader's choice. Depends on your patience level in the mindset of the trader, right? So what's the buy model? Like I told you again, they open up the week, they set the low, right? They come back into the A range. We basically delineate the high and low of the A range. What are we expecting? That we have these lows here, we have these lows here. So then when we come out of 12 o'clock, they come out shoot low. When they come out shoot low, look how obvious this is. Look what they do. Look, they come right below these lows. Look at that. They come right below these lows and form a pattern that we can do what? Identify. A small what? Impulse and correction and continuation. Same concept. It just has a different framework in it. A little bit more framework in the intraday process of you getting in on your trades. Like if you struggle with entries on your trades, guys, this is it. If you struggle with entries on your trades, it's the timing that a trader is trying to overcome. When is the right time? And so you have to have this timing format to be able to align yourself with your higher time frame analysis. Make sense? Cool. So you got to have a buy model. So, and then you have to have that framework. And these two simple tools is all a trader needs right here to be able to do that, to frame the time. And, you just toggle them on and off. Simple enough. And then you set these ranges for the week, and then you can basically trade in sync with the higher time frames from this framework, just from this simple framework, right? And I put this together so that when I started beginning to share and teach other traders, it's a very simple framework for you to be able to have these two indicator tools, and it delineates this information, and then it gives you a framework for trading the higher time frame premise from an intraday perspective, because the intraday move turns into a swing trade, right? That's how you get in on this entire trade. But you have to break it down into multiple days. You have to break it down into multiple days, right? So that's what you have to understand, okay? Because without this information on your chart, you're just looking at blank data. You don't know what the timing element is. You don't know when, what, where, right? You see? Now you don't know anything. You know data is there. You know that, you've seen things happen, but you can't go back and actually see what was engineered, when, where, and how it was engineered. You can't see exactly the time. You can't see the expansion. You can't see